Okay, so I'm doing another webinar, and this time I'm going to do it on divergence. I'm wondering how anybody, does anybody know? No, Boykie, not today. There is a reason, but we won't go into it. Divergence. Okay, what we use divergence for is to gain a little bit of an edge onto when we think the market is going to turn. Now, the idea of divergence is when the price diverges from the actual indicators that you are using. I use stochastics, as you all know, and the RSI. And the reason for doing it is I find that although the RSI is a bit of a lagging one, stochastics are a bit of a leading one. And if you're looking at divergence, you really want to be that little bit more above anybody else. So I've got up here the Canada yen chart. Now, I've picked a few examples of how the market diverges from price, and this is one that I've come up with. That's the wrong chart. This is the one that I've come up with, moving on to the other chart. Okay, we're going to do this one. This is the euro yen, and I'm sure everybody's interested in the euro yen. Okay, you can see here where it made a base and we went up, and we got quite overbought on the market, and we started to turn, and we came down, not a lot. We came down to just between the 50 and the 61.8% retracement. Now, when the market rallied again and made new highs, what you're looking for is something to tell you that perhaps is a false move, or you're going to be on reversal watch. And you can see quite clearly, if I just get rid of that and switch that out of it, you can see quite clearly that when the market made that high and the price went lower, we climbed back higher, and as we made new highs, the oscillators diverged from where the price was. So what you're saying is even though that market went higher, the stochastics failed to make a break above this one. Now, that will tell you, that's giving you a little clue that the market is about to top out. So that's what you're looking for. So you go to your RSI and you're seeing the same sort of thing. It's a little bit more clearer here, but the picture's still the same. You see where we made new highs there? Fine. This didn't happen over here. We came down, we touched the 50% line, we started to turn up, and here now we've gone higher, but the price, we've gone higher on the price, but we haven't gone higher on the indicators that we use. So you go into reversal watch. Now, is that clear to everybody? Okay. I have no idea how many's in the room, and if you want to see other charts on a shorter time frame, depending on how you trade, alright, you're always going to have a daily chart up, because you've always got to know where your price is from a daily chart point of view. It's quite important to do this, because it does give you a broader outlook of what the market and the longer term, medium term traders are doing. But if you, say for example, trade a 5-minute chart, you can trade this really with any time frame whatsoever. You can go to a 5-minute chart, you can go to a 10-minute chart. We'll have a look at that in a moment. I've showed you the diverging indicators on the euro yen, which I think was quite important. The other one that's quite important is this Aussie. You can see quite clearly there where the market made top, came down, didn't come down a lot, went higher, but you see this mass here You can see this really does show you that the market didn't want to go up and was going to come lower. Now that's your first clue. You can incorporate that with your support and resistance levels, as well as your other technical indicators that you're using, trend lines, whatever it is. But at that point here, you were on reversal watch. And the other thing that made you think that the market was going lower, if you go across here, you can see quite clearly you've got a triple top. We knew where the resistance was, we preempted the move, and once it broke through the 200-day moving average, we were on our way down. Now, obviously nobody knows how far the market's going to go at any given time, but this particular chart with this and this here did show you that, you know, it was due for quite a good move lower, which we've seen. Now around here is where your support is, so now we're looking for divergence here. You've got it again. You go to this point, that was the lows, the price is lower, but these are lower, but not as low as over here. So you're looking for the market now to turn and go a little bit higher. Now, is this daily chart too long-winded or too long a time scale that you would actually look at? Anybody want to answer me? Okay. So within the Aussie, then we're looking at within the Aussie, we're looking at the daily chart. You can go out and find excellent diverging patterns if you're using a 240-minute chart, if you're using a 60-minute chart, if you're using a 5-minute chart. These will always be able to help and guide you as to what the market is expecting. And the reason it's doing it, and the reason it does this, is because it goes on. It's like a moving average, but it isn't. It's like a front-running moving average, and you're looking for the crossover for it to go lower. So although on the daily chart your price is looking to go higher, you look out to these shorter term charts and have a look and see whether or not we find that the market is going to go lower. And there you have it. Look, we tried to made a new high on the stochastics. When we made another high, the stochastics was lower than the previous one, so down we come. That's what we're looking to do. And we could possibly come down to this level here, and these will start to change, and then you'll be able to look to where to instate a long. Refresh camera. Not sure, I don't know how to do that, sorry. Okay, Boyke, the reason you're absolute... Okay, fantastic. Boyke, the reason that these tell you what direction the market's going to go, and they're leading indicators, we've been through this before. I know I talk about stochastics all the time. These stochastics are leading indicators, not lagging indicators. Every other indicator lags, apart from these stochastics. I don't know why. I never asked the reason, really. It's just I've always known that they do. So this is why I use them to get in and out of trades, because they do tell you more information. And when they diverge, it's just a double bubble, really. You have to keep your eye on the price and the stochastic to get that turn in the market. And you can do it, you really can. As can be seen over here. You know, it's just a matter of just looking at it and just looking at it every day. Look, high, stochastic high, higher high, stochastic not so high, higher. you know, we are on our way lower. There is nothing difficult, apart from most of the other indicators lag from the stochastics. Well, I use a 10-3-3 stochastic setting. You can use a fast stochastic, but the trouble with that is it's not as good as the slower one, and the reason for that is because it's too whippy. So it whips about a lot and can get you topped and tailed. You know, you're better off looking at the longer term stochastic, and it's not that much longer to wait. I mean, you can, here look, if the price gets down to here on the Aussie, you know your stochastic's going to be down here. So you can preempt them by buying in front of this low, knowing that these stochastics are going to change and move higher. You go in at a trade, you go in to trade from a position of strength, and your position of strength is buy in front of a prior low. Stochastics, boy, the key. They're all lagging apart from stochastics. And that's how you treat them. You treat them as an entry and exit point if they are going in your favour. And also, it shouldn't be done, but I have done it I have done it a few times, and I'll show you how it doesn't work later. But I have done it a few times when I have preempted a move and it's gone the other way, so I'm left with a wrong position. But I know at some stage these stochastics will be so overdone. They will be so overdone that the market will eventually turn. And when I say eventually, if you're looking at a 60-minute chart, you're only looking at a 1 to 2 day time gap. Well, divergence on the lows, not really, because you've got that low there with lower stochastics. We haven't made a new low, and we certainly haven't as yet made lows on the stochastics. So that at the moment isn't diverging, okay? But I understand what you're saying. But no, it's not diverging as yet. Now, if we go take this to this chart is going to look pretty sad, but I do realise, well, it's well, if there is, I can't see it, because I look at that low there and I look at that hasn't made it, but nor is that. So unless it crosses, it's not really a divergence, I'm afraid. Sorry guys. What percentage does it work? I would say it probably works 70%, and that's a really good percentage for these. But I've used them for many years now, and I like them. And if they work, you know, why really bother looking for anything else? Now, a lot of traders don't trade the way I would trade, and they look at 5-minute charts. Yes, Mel, you do have to be very careful, because they use CQG. My favourite divergence setup with trigger. Well, it will be something like this. Would have been something like this. Actually, was something like this. Yeah. Where you knew that you had an awful lot of cover here, so your risk reward was really good. So, for example, your stop would have been above here. Okay. Now, we look at the Aussie and trade the Aussie quite extensively. So, I know this contract, this market inside out. So, this is what we did. We sold up here. Oh, our stop was going to be above here. Now, we actually took profit too soon, I have to tell you, because once it broke through that 100-day, 200-day moving average plus that trend line that I'd put across there, we got out. Now, it did come back, but as you can see, it didn't go back above the trend line. It didn't go back above the trend line here. We were still seriously diverging on the stochastics. So again, your stop was quite easily yeah, I know, and it seemed a good trade at the time. Now your stop was easily put above this place, above this line and the moving average, and you can see where it just ran all the way down until now. We're beginning to see the stochastics start to turn. Now if we see that on the daily, we go into the 240 minute, we have a look and see what that's doing. No, that's not showing it. That's showing it still going lower. Go into the hourly, what's that telling us? Not really telling us a great deal, apart from we're buying down here because we know where the stop is. So now let's look at a 5-minute chart, which I know a lot of you look at, and I personally don't look at a 5-minute chart. Yes, I do look at the dollar Canada. Do I look at the dollar index? Yes. No, not when I'm analysing dollar pairs, because what happens is that because the dollar index is made up of like 60% euro, that it's quite difficult then to decide what dollar pair is going to go where and what in relation to the dollar index. So you're either just selling the dollar index futures or looking at the individual dollar pairs to see what they're telling you. Yes, I do scale in and out of positions quite, yes, to answer your point, Alexandra, I do. But on this particular one, we did scale in, we did scale out. Yes, you should have let it run, but a 200-day moving average is quite a significant thing, and then I wasn't around, and that was it. By the time I got back, it had already done its little thing. But scaling in and out of a position, leaving trailing stops, using your stochastics as entry and exit levels will, you know, make you money 7 times out of 10. As Mel pointed out, it all does depend on the system that you are using. So I only go into a 60-minute chart, but if you are trading very, very short term, and I know a lot of you are, you've got to completely ignore all these lines. But can you see, again, you get these little patterns, you get these little signals right the way through the market. You've got one there, you've got one there. Can you see that? Okay. Well, I'll go off the Aussie now and go on to, I think, the euro dollar. I think that's the most active one people are trading at the moment. So we're going to have a look at the euro dollar and see how many little ones we could have got out of that. Now the euro dollar has actually been, strangely enough, quite quiet in comparison to other markets. So that's been, you know, but still you have this pattern. Still you're looking to, we was in this one as well, still you're looking at looking for divergence. There you go, you've got another classic example. Can you see that? You've got there where the price goes to 132. It comes down, doesn't really break any significant levels. It goes up, it hits the 50% fib level, you can see where the stochastics were so diverged, it could only come lower. There actually it hasn't come as low as the other currencies. Why? And this is why you've seen the euro crosses go the way they have. Mel Stan, be careful of using charting packages, boy kids, because some of the charting packages around now are normally free and with the broker that you use. For example, if you use ETX, if you use CMC, whatever charting package you use, although you're entering the same parameters of the 1033, these spread betting companies create their own prices to quote you. So a lot of the time, me and Mel, we have different stochastics. A lot of the stochastics that Mel have turn before mine do, and then what happens with that is that you're slightly out of whack. So I use I use CQG because I just find it one of the best, well, for me, the best system around. And I think if you're trading, I don't think the price is that much compared to how much you can make trading using these indicators. Okay. Well, if you look at the dollar index now, we're double topped on the weekly chart. Now I am looking for a turn in the currencies. I'm just not sure what one's going to lead it. Personally, I think it's going to be the Aussie, but I'm not sure. Alexandra, Bollinger Bands. Okay, the trouble with Bollinger Bands is this. If I just put them on, they move throughout the day. So if you go back in history, at that point there, they're looking quite good. But if you was actually trading the market there, that Bollinger Band wouldn't be there. Because it's just an average of the prior price. Okay, I think one of the best cheaper ones you can get is E-Signal. That would be my second choice. If I didn't have CQG, I would by far go to E-Signal. Well, I've got both. Okay, and don't you like candles? I don't, and the reason, look, yeah, let's put a candle, let's change that. There's no difference, really. I think they look pretty, and on my reports, I send them out. If you look at what a candle is, like, people would be screaming, my God, that's a, what do you call it, whatever that pattern is, okay? If you look at a bar chart, it doesn't really take a rocket scientist to go, oh look, it hit the 50% line and closed lower. Now, that's because, shooting star. They probably are. They probably are. Oh. I'm getting confused now from Pan on Fire with his shooting star to Mel saying, but they are one of the best. Keep up, gang. Keep up. You can you see what I'm saying? There really isn't anything in a candle chart that tells you anything different. But then I was just self-taught on bar charts, because until 1987, when I joined Nomura Bank, we didn't have candlesticks. All we had was bar charts. They weren't freely available. They didn't have the things that you have today. It just didn't happen. And I suppose because I've been trained, if you like, self-trained on bar charts, for me, I can read them easy. But I understand why people use candlestick charts just to differentiate up days, down days, days when they've gone up. I am from the old school. Yes, I'm afraid so. Yeah, I am from the old school. But I use the, if it's not broke, don't fix it sort of thing. I don't see the point, and believe you me, working for a Japanese bank as I was and did, there was absolutely nothing that they taught me that worked as well as just looking at a bar chart. And you know, there was me trading. I was head of technical trading at I was technical trading manager at Nomura. God, memory's going. And beside me I had a little Japanese guy, and he used to try his hardest to teach me about candlestick charts, you know, but it wasn't going to happen. But because I worked in a Japanese bank, I had to use them for sending out to Japanese customers, obviously. So I'd do my analysis, give it over to him. He'd cut and paste, which is all we had in those days. He'd cut and paste his candlestick charts onto it. Nomura Bank I worked at, he'd cut and paste his little candlestick chart over it. We'd photocopy it, and out it would go. Yes, it was in the UK. We was based at Monument initially. It was different from Nomura International. Nomura International was a stock market company that did all international stocks and bonds and what have you. And they decided they wanted a foreign exchange arm of their international dealing desk, I suppose. So luckily I was working for Midland Bank at the time, and my boss was made treasurer of Nomura, and he took 5 of us with him to help set up the bank. So now when Nomura Bank, I think it's all amalgamated now into Nomura International Bank, whatever it is, but it was only Nomura Bank. And actually, if you Google it, you can, yes, that's correct, Nomura. And if you Google Nomura Bank from like 1987, we only had the banking license 2 days before we went live. So it was quite a catchy little thing. But I loved the way Nomura went on. It was like, shall we start our own bank or buy Citibank? I mean, really? But they were that big at the time. I think they owned 75% of the American debt, so you can imagine, can't you? And then it all went horribly wrong, and there's a really good book out called, well, not out now, I mean it was out then, years ago. It's called The Rise and Fall of the Nomura Empire. Luckily I only did 3 years there, then I was out, because it was actually a money laundering bank. So no, I don't have shares in the bank, thank God. I got out and took my shares with me, which at that point was, you know, they were quite expensive, so I did all right out of that. But no, they were money laundering, which is, I don't know if I can say that on here, but yeah, they were. So it was quite exciting, because what they didn't realise was one of the guys that came with us from Midland Bank, his father had been in the Navy, the American Navy. He was fluent Japanese, so when we'd go into meetings, you know, he spoke with an American accent, but they didn't realise that he was absolutely fluent in Japanese, and that's how we found out all the terrible things that were going on. But by then it was too late. We didn't know, you know, we didn't know what to do and who to go to. Anyway, that's enough of my life history. We're talking about divergence and why I don't use candlesticks. They make me itch and scratch, and I just like them because, look, they're really pretty colours, but not so much for telling you where the market's going. But anyway, back to my bar chart. Now, say the stochastics stay here where they are, and for some reason we have this big sell-off in the Aussie, in the euro, and we break this point here. These are going to react slower. This is going to go down here, and it's going to be, look, divergence. This is something you really need to watch if the market goes below this point here, which is 127. 46. The CAD yen. Seriously? Okay. Yes, well, the dollar yen, who nobody wants to trade, was looking to go lower. Your stop was in, and we did have diverging stochastics, but I'll have a look at the CAD yen for you. And do you want it on a longer term or short term basis? Yeah, CAD yen. You can see that, can't you? You see where it just, that's that bit down, still in an uptrend. In fact, I'll put a little trend on there. We'll put on a little fib level on there. There we go. And you can see quite clearly that the stochastics and even the RSI is looking for the market to come lower. So you'll be very careful, and you're selling up around here. If not, you sell up to here, that moving average, okay? And that comes in at 10020. You're selling here, and you're putting your stop above here, which is 101.05. So you're really looking to outwit the algo systems. So you want to put that stop in at around 101.30. Okay, that will give you enough clearance from the algos that normally want to take out about 15 to 25 points from your stop level. So that's one to look at. Even though you're looking at the chart pattern, your chart pattern's looking quite bullish. Your stochastics are telling you, hang on, I don't think that's going up. So you've got to see what one plays out first. Personally, I would go with the stochastics. That's the way that I would do it on that. Now, are there... dollar CAD. Do you know what? This is why I really love charts. I wished I had enough time in the day to actually go through them. You see, again, look. There. It has made a new high. It's not there. They're turning down. Okay? So we'll... pull that down a bit. We are diverging, but let's get a bigger view of that. Yeah, you'd be selling the dollar CAD with stop above here. Can you see why we're doing that? High. Lower, another high, not high. Can everybody see what I'm looking? No, I don't. I don't think you can. I think you can trade that actually. I'm not sure. Or if you do, I can't. I can't get it on my system. Okay, pan on fire. Do I have to keep calling you Pan on Fire? I'll call you Pan for sure. So you can now. Now, does anybody else want to see anything else? Right, before I go off of this, particular chart, there is one more point I really do need to make to you. And it really is quite an important point. These stochastics, if you trust them, and you should really trust them, if you're a CQG system. If you haven't got a CQG system, ring me and I'll tell you where they're going. Now, markets always look stronger or at their strongest when they're going to turn. Put your stop above that more, I would think, at 10. I'd go above 103.01 because that's just too short. Because look, that's 103.14. That's 103.43. Let's just draw a quick trend line. You see where you have, it's not a trend line because it hasn't been touched 3 times. Okay, it's a resistance line, and the problem with it is, I think the trouble with the retail market is they don't have deep enough pockets to actually be able to trade like a professional trader or how the banks trade. Obviously, they can't run the position, so you could wait before you sell up to this resistance line. So, but there's always the chance because of these that it's not going to quite get there. So if you could scale in with whatever size you trade, unless you're trading 50p's, and people do trade 50p's, if you can scale in to a trade, I think it's better if you truly believe that the market is going to go your way. Now this particular market on the dollar CAD, it really does look like it's going to come lower from this. So a very low risk trade would be to trade up to 103.14 and put your stop above this point here. Traders have very, very short memories. They're not looking at what's gone on over here. It's only if you're a technical trader, which I am, that you're actually interested in, hey, well, you know, what went over here? Well, what went on over here? And that, oh, spooky. And I do like look and see what went on before. And now you have 2 really good reasons to sell this market, because you've got a longer term trend line coming in at like 103.19. So although the market is trading higher, this is where it's okay to be a contrarian trader, and people do trade contrarian. Is it contrarianly? Not sure, but anyway, contrarian traders are out there, and they love things like this, and that's what happens with retail traders or people that, you know, do it a bit part-time, is that they'll look at that chart and they go, yay, the market's going higher. Whereas I look at that chart and go, yeah, no, not so much. And I would expect the market to come back to around this level here, between these 2 levels here, which is, as you can see, 101.87 to 101.51, where the 9 and 21 day moving average intersects. Now, to be absolutely 100% sure, you put on a Fibonacci level. Now you can see there, as I move it out, intersecting just below your 50% line. But that level there was also on that moving average, so you can see that sort of, we are going to come back to around this sort of level if you start to sell above here. Now if you're already short, it isn't a problem as long as you know where to put your stops, and that's what trading's all about. Now I personally think that when you enter a trade, your stop loss should be the first thing that you think of, because there's an old saying, is look after your losses because the profit take care of themselves. I use a 9, 21 and 55 moving average, boykin. Mouth's drying up. So markets look strongest when they're going to turn, and they look the weakest when they're going to turn. I use a simple one. I do sometimes on a weekend, if I'm not going out anywhere, I'll have a look at the exponential as well and see, you know, what one worked the best out of a bunch. And I've always found the simple ones actually work better. And I think that the bank traders and don't forget the hedge fund managers, they're not that much younger than myself. So they've also worked in a banking scenario where simple is better. But you know, try them out. Look around, overlay them, and see what ones you think that you feel more comfortable with. The way that I find that they work is that when I go back and look at what the week has done and put on the simple, then the exponential, I do find that the simple have given more support, if you like, and resistance, because I don't treat them as any trading tool whatsoever. It used to be, before we had anything else, you'd trade on the moving averages, and like I used to find them a complete waste of time, because by the time they'd crossed, this is not a great one, but you know, by the time they'd crossed, you'd missed a lot of the action. So I use them now as purely for support and resistance, and I don't really look at them that much unless other things guide me towards looking at them. How many trades in a week? Do you know what? It all depends. It really all depends. I believe that you should only do 3 to 4 trades a week. That's what I think. I think being in and out on a daily basis, all you're doing, you're actually making your spread better, richer, and you're not really concentrating on the bigger picture. And I think that's where the retail market falls down badly. And don't forget, they're not going to tell you, they're not going to say to you, you know, they're not going to say to you, hey, I don't think you should do that. I think you should trade 50, 60 times a day. That's what they would want you to do. Well, you shouldn't. 3 to 4 trades a week is more than enough. Because you've got to sit back and you're not becoming, what's the word? It's not focused. You lose something. If you're looking at a 5-minute Eurodollar chart, you're missing so many other things around you, like the stochastics, like divergence, like Fibonacci's. You've got to take a longer term view, you know, and play them at their own game. You know, if you don't trade a lot, okay, at some stage they are going to have to trade they're going to have to change their ways of spread betting and raping the. Oh, it's like, funnily enough, we do trade the Aussie Kiwi cross, yes. Spread betting forex safe. Do you know what? It's safe if you know what you're doing. Right? It really is safe if you know what you're doing. What you are saying, Jano, is so much the truth. Everybody, every trader is bad with sitting there. Why? Why are you bad with sitting there? You put your order in, you put your stop loss in, you have a target in your mind, you go away and you come back and you see whether or not. How did bucket shops get that? Betters. That's because a spread, I could tell you actually because I do know this, a spread is what the foreign exchange market used to quote. Alright, you'd always quote a spread and it would be a tick or two, for example, on interbank. On your clients, you'd probably give them a choice price, which is like, I'm looking at the dollar CAD now, what's in dollar CAD? They'd go 87, choice. And customer would then trade either or, either buy there or sell there. Now, when you're trading interbank, it would be, well, what are we now? We're 88, 87. So really, the real market is 85, 88. 3 tick spread. So, that's where the spread comes in. Betters is because it's a tax-free platform. You don't pay tax on your profits or your losses. So they're betting. But that's why they're called spread betters. Because I remember back in the day when they all started out, and that's why they're called spread betting companies. You're not safe in Forex. No one's safe in Forex. Because you're betting. Your tax is paid in your spread. So you shouldn't have to pay tax. You don't pay tax. And it's not only in the UK, it's anywhere. If you're on a spread betting platform, you don't have to pay tax. Which is why most of America are not allowed to spread bet. But they do. We know that India, a lot of Indian traders and Pakistani traders spread bet. They're not allowed to, but they do. So that's why you've already paid your tax in your spread. Okay, bit like horse racing. Okay, if you pay up, it is. Yeah, I mean, and I hate to say it because it goes against everything. It goes against everything I believe in. But yes, it's classed as gambling. Yeah, it's in the same league as, I mean, Gibraltar, for example. I live in Spain, but in Gibraltar, the gaming companies actually run Gibraltar. It's made it the place it is now. There's about 85 gaming companies, and these gaming companies are knowing that, look, if you're going to gamble with bingo or poker or whatever, why not the foreign exchange market? No, Jano, if you're on a spread betting platform, you pay no tax. None. So anyway, no, I'm not in Jib, I'm in Spain. They are trying to change the law, obviously, but for the moment, they can't. Do you know what I mean? They're going to have to change the law for the world. And I mean, you know, they're not going to change. They can't do it in Spain. They're so far behind. They might do it in England because, you know, you're all skint over there. Well, you're more rich than what everybody is in Spain. But they are trying to change the law. But, you know, it's a big task, and I'm sure the spread betting companies are going to fight. But do you understand now how... It's interesting. It is interesting, I think. What did you say, Boyke? I've got like... Is it interesting, or... JS is interesting? Yes, but I'm running out of time now, and I want to tell us more. No, shush, I can't. They know where I am. But, has everybody enjoyed this webinar, and more importantly, are you going away with something you've learned? Please say yes. Yeah, I do. I do tell it as it is, but I'm sure I'll get, you'll get me one day, but there you go. You know, do you know what, I'm too old to care. I don't care what they do. But I'm sure, mind you, FX Street hasn't closed me down yet, but I know there's somebody sort of next. As long as you've enjoyed this and you've got a better understanding of how stochastics, RSIs work with a strong market and how they can change, I really hope that you apply these to your trading, and you don't trade for the spread betters 20, 30 times a day. Take time out. Take your time. Look at what the market's doing. Look at what it's telling you. And it does, it speaks to you. Okay? Well, I'm not enjoying it today, it's been raining. But it's due to be nice as from tomorrow. We shall see. Look, you all have a great time, yeah? And until next time, what you can do is actually have a go at this for me. Next time, we'll have a look and see whether or not, by sitting back, looking at the market a bit more in depth, you can actually make more money. Solid gold. Okay, of course I do. You're all more than welcome. Yes, stochastics are good for any time frame. Alright, any time frame. Right across the board. Obviously, the shorter term you go, okay, the less amount of profit you're going to make. And what you're going to do is you're going to age yourself. Okay? This is why I'm still, at my age, doing what I'm doing, is because I haven't burnt myself out trading lots and lots and lots. The settings for stochastics are 10, 3, 3. I don't know about a spring chicken, Mel. More like a boiled hen, but now, there you go. Okay, no problem. Until next time, I'll see you all next time. Bye.